think it was in the early 80s, people were buying up the real estate next to the New York Stock Exchange. The coaxial cables gave you a signal that was just a little bit faster.
I was just trying to think back through the history of how Tradfi markets were trying to do what crypto markets are doing, which is just speed up the flow of transactions.
Do you think you got more comfortable with the concept of sunk costs being involved with stocks for so long?
I think so, and maybe even growing up playing baseball as well. When you're trying to hit a round ball with a round bat, and the best are only successful at doing that 30% of the time.
Ted Williams wasn't even 50%. Most exchanges, Mike, seem to pick a lane, retail or institutional.
What we've built is a really diversified, all-weather crypto business model that has a lot of different levers to pull depending on the market environment. Doesn't necessarily lean only into retail or only institutional.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers, the show where we talk with the world's top CFOs and finance leaders. I'm CJ, a tech CFO, and my goal is to unpack the frameworks and operating principles that make you better at allocating capital and leading teams. On today's show, I'm speaking with Mike Wilcox. Mike is the CFO of blockchain.com, one of the longest running and largest platforms in the crypto ecosystem. In this episode, we go deep on how exchanges think about serving two very different customer bases, retail investors versus institutional ones, the different ways that exchanges make money, and the tension between blockchains being radically transparent and the unique first-party data that exchanges generate. If you like the show, please remember to like and subscribe. It helps us with the algorithmic overlords. And if you're looking to hire the best finance and accounting talent, I'd love to help you. I run a recruiting service that pairs you with thoughtful, qualified candidates from our warm community of finance leaders. People who voluntarily debate LTV to CAC frameworks on weekends. If that's of interest, shoot me an email at talent@mostlymetrics.com and we can talk. On to today's episode with Mike. Mike, thanks so much for joining me on the podcast today.
Thank you for having me.
So you've spent more than 25 years across capital markets, sell-side research, and investment management. Now you stepped into the crypto world. What was the biggest change you had to wrap your mind around when you made that shift?
Yeah, it's really kind of speaking a bit of a foreign language, coming into the crypto world from traditional finance. But I've actually found there's a lot more similarities and differences, different nomenclature for products and services and things that we're doing. But we're all trying to facilitate, the movement of capital in an efficient way and in a compliant and trustful way for consumers. So the more I've been able to kind of identify the similarities, the more it's been able to facilitate a seamless transition.
That makes a ton of sense when you say it like that. We're all just trying to enable moving money around, no matter what form it comes in or what term you use.
Yeah, that's right. That's right. And, this company has been doing it for a long time. Blockchain.com was one of the first crypto companies around, started as a data layer, helping people understand the movement of money on the blockchain, and then evolved into a global wallet infrastructure platform operating around the world now with over 40 million verified users and having processed over $1 trillion of transaction volume over our history. And now with the onset of more and more regulatory clarity, we've had an acceleration in institutional adoption on the platform. So it's exciting times for us.
We're going to touch on the data point, but sometimes I'm like a dog with a bone when I hear something. I'm just chasing a car. It's so fascinating that some of the more durable companies start off with educating, so leading with analytics, leading with information, and then that becomes an on-ramp to another type of commerce.
Yeah, I think, that's just kind of been our DNA. Build trust with the consumer, help facilitate knowledge and information and data and analytics. And now we've turned that into a real strategic asset for the company in terms of how data informs a lot of the decisions that we make and the insights that we have as a management team and as a company that helps inform, product and service decisions that we make.
Crypto has always had a rebel, contrarian DNA or streak to it. It pushes against traditional finance in a lot of ways. But you as the CFO, right? Sometimes I think of the CFO, everybody's playing offense. I have to play goalkeeper. I have to play defense a bit here. How do you, Mike, balance being on the corporate side of rebel versus the rebel side of corporate, if that makes sense?
Yeah, the way I've always viewed finance is really just an embedded function within the business. It's not some separate department that's like an audit or accounting function. Our goal is to really partner with the business to provide the types of insights that help inform better decision making, better capital allocation decisions. Because the more we can do that, the more we can identify the right KPIs and value creation levers, within each team, the more that can roll up into, the overall success of the organization. So I really challenge my team to get to know their product and engineering counterparts and their revenue counterparts, to sit alongside them and really understand the challenges that they're trying to solve for, and how we can partner together to really create lasting value, both for our users, both consumers and institutions, and in crypto native foundations and partnerships that we're creating, but also for investors.
Do a lot of the members of your finance team come from a traditional finance background, say from fintech or from SaaS, and they just became passionate about crypto? Or I'm just curious about the career trajectory of how people end up within a certain sector.
Yeah, it's kind of a mix, actually. So we certainly have a few Tradfi folks on the team, myself included. And one of the things I'm most proud of is how we've assembled people that have varied backgrounds, both internally, that have great pedigree and institutional knowledge of the blockchain.com platform and the products and services that we offer, but also some other world-class organizations, whether it's Revolut or MasterCard. You really bring the best of both worlds, where you have deep, powerful insights of our existing offering and platform, with some outside perspectives on, what some other world-class companies have done in terms of setting up their financial and accounting infrastructure.
That totally makes sense. And it kind of leads me into a question on banking relationships, because that's been complicated in crypto, right? How do you think about building durable financial partnerships in a sector that some banks still approach cautiously?
The industry has a history where in some cases it's been difficult to onboard, some of the global, tier one multinational banks. I think the good news is with the improving regulatory environment, we've seen an increasing interest from a lot of those players who might have been reluctant in the past to help set up global banking rails and partnerships that's helping, us, provide better solutions, better on-ramps and off-ramps for our users. We really tried to build redundancy into the system in terms of our banking capabilities. This helps us, reduce cost to serve for the consumer. It also, creates that redundancy and business continuity if we ever have a challenge, with a banking partner, if we want to upgrade, level of service that we're offering. So I think that's just the key is just planning for redundancy in the system, so that you can offer, the best capabilities to the consumer.
Stupid question. Can you explain what on-ramps and off-ramps mean? Because I have a conception of it in my head, but I'm not sure if it's right.
I bet it's right, but it's the way that you kind of bring, your fiat capital into the crypto native, infrastructure. So, you may link a bank account to your crypto wallet so that you can bring capital into and out of the crypto ecosystem, as you wish.
And that's pretty important for traditional banks, right? To figure out how to get money in and then get your money out.
Yeah, that's right. That's right.
Most exchanges, Mike, seem to pick a lane, retail or institutional. How do you think about that split at blockchain.com?
Yeah, so our heritage is primarily in the retail world. As I mentioned, we grew up as that data layer, providing insights to users on blockchain transactions. That morphed into a wallet infrastructure, which has grown enormously around the world. It's really diversified into this, broad platform that offers what we call a consumer super app. So it's that wallet infrastructure to be able to buy, sell, swap into tokens, across 90 million, registered users and 40 million verified wallets on the platform. And then we built an institutional prime brokerage business, which has really accelerated in the last several years. and has quickly become one of the more dominant parts of our business, which is not for the lack of growth in the retail business. There's just been so much institutional adoption. And then, more recently, we launched this service called Blockchain Market Services Infrastructure. And so this is where we really partner with crypto native foundations and protocols in helping bring their tokens to market. So we seek out like the best themes that are taking place in terms of financial products coming on chain and help enable those tokens to find liquidity in the market, manage that liquidity, help with custody and staking solutions, for foundations. And so, what we've built is a really diversified, all-weather crypto business model that has a lot of different levers to pull depending on the market environment. And we're really proud of kind of building what we think is a differentiated mousetrap that doesn't necessarily lean, only into retail or only institutional. There's good synergy between all three of the main pillars of business lines that we offer. And that's been really effective in our go-to-market strategy.
Hey, thanks for listening. We'll be right back after a word from our sponsors. If you're paying for A-level finance talent, they shouldn't be doing B-level tasks. CFO time is expensive. Senior finance hires are wicked expensive. And yet, in many companies, highly paid operators still spend hours reviewing expenses, chasing receipts, and reconciling systems that should already be automated. That's where Brex comes in. Brex is an intelligent finance platform that combines corporate cards with built-in expense management and AI agents that automate the repetitive work finance teams usually handle manually. Transactions are categorized automatically. Receipts are matched. Policies are enforced in real time. Reconciliation just runs in the background. So instead of adding admin as you grow, you increase output per finance hire. Brex is already automating hundreds of thousands of hours of manual finance work every month across 35,000 companies, including Anthropic, Coinbase, and DoorDash. If you want your finance team focused on performance instead of paperwork, check out brex.com/metrics. That is brex.com/metrics. You just launched a new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. Here's a growth tax nobody talks about. Every new monetization model you ship creates a nightmare for your finance team. Add usage-based pricing? Now you're tracking consumption against commitments. Launch product bundles? That's multiple performance obligations per contract. Offer mid-cycle upgrades? Woo! Good luck reallocating revenue manually. But that's exactly where RightRev shines. RightRev is the revenue recognition engine built for companies that can't afford to let accounting slow down growth. When your rev rec is automated, your product team can ship new pricing without asking finance for permission. And your sales team can close creative deals without worrying about downstream chaos. To get up on my CFO soapbox for a sec, I love talking about creative pricing models, hybrid pricing, credits, tiered usage. But I've seen too many companies where the sales team is celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. In a world where your pricing model might change 3 times next year, that flexibility is everything. If you want to scale your monetization without breaking your books, visit RightRev.com. That's RightRev.com, where modern monetization meets bulletproof accounting. Maybe just to riff on this together for a second, and it doesn't necessarily have anything to do with crypto, but I often wonder with any business model, is it easier to go from retail or call it like B2C to B2B or institutional, or the other way around? And Mercury right now, they're extending their banking services from small businesses and startups to now people individually. I guess I have to say banking services with quotes there. Do you think in business it's easier to go upstream or in one direction versus the other?
For us, it really doesn't. We've built the business in a way that has a common infrastructure platform. So the technology stack that we use for our retail business is very similar to the institutional business. So is the regulatory and licensing infrastructure. And so we've been purpose built in terms of building that modular infrastructure that gives us agility and flexibility to address new business opportunities or revenue opportunities as they come without having to build like an entirely new tech stack or back office infrastructure. So that allows us to have really good unit economics as a business and, a lot of leverage, particularly when times are good to be able to scale up.
That's amazing because you can kind of build once and use it multiple times.
Yeah, it's a pretty unique feature of the business model that we think really stands out for us and adds a competitive differentiation and advantage for us.
I was speaking to the CFO of Rivian last week, and she was saying that you have to sweat the capacity you have. And a lot of that, I think, goes to any part of business where you've already built the infrastructure. You want to have the most throughput possible before you go and build again.
Yeah, that's right. And we kind of take the same approach with personnel and say, look, this is the team we have on the playing field. We need to get the most out of them.
From your CFO seat, how different are the unit economics of retail versus institutional customers?
We don't really break it out that way, again, because we do have that common infrastructure platform. So it's a shared resource and cost center for both the retail and institutional business. We don't really think about institutional and retail customers differently because there is interplay. There's high net worth in between there. We see customers migrate, across different areas of the platform over time. And so we've generally found it to be in our best interest to not really segment our user base that way. And so we don't really look at the unit economics in that way.
I'd imagine, though, there's a go-to-market strategy that's differentiated, even if, because you make a great point, there could be a very high net worth individual who is as big on paper as, a medium-sized institution. I'd imagine one is more product-led growth and the other is maybe, I don't know, is it biz dev related?
Certainly the branding and the marketing that we do has a halo effect across the entire organization. We've certainly see that play out in terms of our ability to address consumer segments, build institutional relationships and really create strategic partnerships with crypto native, financial services providers. But certainly on the institutional side, there's a bit more of a white glove, service component to that and a relationship, building component to that. And I think, one thing that sets us apart is, the 12 plus years that we've been in the industry. We really are, at the epicenter of everything that's crypto native. We're still founder led, and our management team has over 70 years of crypto experience, and so we have broad and deep relationships across the crypto ecosystem, which really helps us in terms of business development opportunities and sourcing strategic partnerships.
That makes a ton of sense. And I think when you earn the trust at the individual level, that person brings that trust into their company. I was riffing with somebody the other day about Super Bowl ads. And so ChatGPT and Anthropic, they spend a ton of money on Super Bowl ads. And I'm like, you know what? This is both a B2C commercial and a B2B motion because someone is going to use that and then bring it to work with them someday.
We have a strategic partnership with the Cowboys. It's been, really successful in terms of driving retail awareness, activation, but it's certainly very powerful too. And, we have the credibility with institutions and crypto native players of just the level of scale that we can play at in terms of our marketing and branding, and certainly bringing them to events and, having deep conversations about things happening in the crypto ecosystem, strengthens our ability to really build those strong relationships.
You have an incredible domain name and a lot of brand equity that goes along with that. As a CFO, how do you wrap your arms around something like brand equity? Can you point to it on the balance sheet? Is it just something you know?
I think it's something that it's certainly an intangible. One thing that it's done for us is really drive a super low cost of acquisition, as there is great organic search. When people are looking to do things on the blockchain or to open a wallet and things of that nature. So our founders were pretty visionary in terms of locking down that domain name as well as some related domain names. So we're very grateful. Having super low activation costs and a really large serviceable and addressable market of registered and verified, wallets on the platform is just a huge advantage for us.
I found your website just by clicking around looking for stuff, not necessarily looking for you. I mean, I ended up on your website eventually, but then there are educational resources on there as well, which helps. We were talking about on-ramps and off-ramps when it comes to getting your money in and out, but what's the on-ramp to understanding a new sector?
Glad you asked that. I mean, it's part of the process, right? I mean, crypto's been around for over a decade, but it's still a relatively new concept for a lot of retail users, and education is a big part of bringing them into the ecosystem. And so we do leverage the website to try to provide unique and interesting content, so that as users come into the top of the funnel, that education process is in place, helps drive conversion, but obviously need to do all that in a very compliant way in terms of the information that's provided in the blogs and in the research papers that we offer on our website.
Do you find that retail and institutional investors are just as emotionally volatile, moving in and out of stuff, or is that a misnomer? I'm just thinking like, would a business react the same way as like me if I was trading? Do you look at the institutions as more of the steady Eddie that will always just do the same thing in a reliable fashion?
Yeah, I think that's generally true, because usually when an institution is coming to be a part of the platform, they're there for a very dedicated reason. They have a business purpose, revolving around participation in crypto markets. And to a broader point, we really grew up in the industry trying to address crypto native, retail users and institutions and foundations, because what we generally found, while the industry is volatile, the more that we can resonate with the crypto native users, whether it's retail or institutional, they tend to stick with you. But I think it's one of the aspects of our platform that's helped us reduce some of the volatility that you see elsewhere.
Just using analog, I have a lot of experience helping to run marketplaces. Not as much experience running exchanges, none actually, but I understand there are two sides to the equation. And when users are multi-honing or they're working across different exchanges, how do you think about loyalty there?
For us, it's about getting the user the best price and the best experience in the transaction that they're trying to process. And so we actually position ourselves differently, and not as an exchange and more as a brokerage model. And so for us, we're really agnostic where we source liquidity from. We're not trying to aggregate it all in one place. We're happy to go out to all the different exchanges to source the best liquidity, the best execution, and the best pricing for customers, and think that's a real competitive point of differentiation. It really also helps us in terms of our partnerships with foundations and protocols. So when they're looking to list their tokens and bring them to market, they look at us as a strategic partner and in a first choice and go-to-market strategy, because we can help them post liquidity on all the exchanges, because we are agnostic to it as a brokerage model. We're not looking to just have liquidity sit in one destination in a winner-takes-all format.
And what's the fundamental difference between an exchange and a brokerage?
So in an exchange, you're simply matching buy and sell orders on one platform. In brokerage, we may have some of that, where we have an active buy and sell order from two different customers that we can pair off. But we also have the liquidity and capabilities from a technology infrastructure standpoint to provide quoting and provide, balance sheet and inventory to process transactions, and then hedge out that risk. And provide a better price and better execution.
Is there a difference then in how an exchange versus a brokerage make money? Are they both predicated on some sort of fee or take rate?
It generally involves a take rate on the transaction.
Cool. Hey, thanks for listening. We'll be right back after a word from our sponsors.
Being a CFO, you know how much I love tools that actually make the lives of accounting and finance folks easier. One of my favorite tools right now is Rillet, the AI native ERP going head to head with NetSuite. Yes, someone is finally doing it. I met Rillet 2 years ago when they were still in stealth. Since then, they've absolutely taken the finance world by storm. Their mission is to make the zero-day close a reality, and they're actually doing it. Customers are literally closing their books at 1:35 p.m. on the first day of the month. They've got everything you need to scale your business. Complex revenue recognition, native integrations, custom reporting, multi-entity, close management, and much more. They're only a few years in and are already supporting NASDAQ publicly listed companies. Yes, seriously. If you want to scale your business on an ERP that wasn't built in the 90s, you need to check out Rillet. Book a demo at rillet.com/CJ. Oh, cool, that's me. That's RILLET.com/CJ. RILLET.com/CJ. Tell them I sent you there. Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today. Pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run. We've all been burned. We've all bought that enterprise planning tool that promised the world, only to realize 6 months later that we've basically taken on a second full-time job just to keep the software running. I want to talk about a company that was built specifically to kill that cycle, Abacum. I actually remember my very first conversation with their founder and CEO, Julio Martinez, over 3 years ago. Back then, they were just starting out in Spain. Fast forward to today, Julio moved the home base to NYC, and they're the engine behind finance teams at Strava, Replit, and JG Wentworth. Abacum doesn't turn you into a software admin. The integrations are actually self-service. You don't need a $300 an hour consultant to plug in your ERP or HRIS, and they're doing AI in a way that actually impacts the things FP&A teams are doing every day. Things like creating variance summaries, building formulas, and modeling scenarios. If you're scaling fast and you're trying to avoid that legacy platform trap, Abacum is the move. They're building the future of our tech stack, and they're doing it with a CFO's perspective. Go to abacum.ai to see it for yourself. That is abacum.ai. How do you as a CFO square the race to zero? So you got someone like a Robinhood, it doesn't cost anything to do a transaction, versus the premium service, white glove, like you mentioned, people are willing to pay for that. Is there a science to setting your take rate when you're trying to balance those two expectations of what's available in the market?
Yeah, we always want to be competitive and certainly willing to kind of look at any transactions that users need to process on the platform. I would say where we specialize in is just the depth and breadth of tokens that we can trade. We provide access to a longer tail. And so people come to us with more bespoke trading solutions and hedging strategies that they need more of a white glove service to execute.
It's interesting because on the surface, you can say, oh, well, there's so many places to go and transact. But when you dig deeper, there are certain value propositions or differentiators that would pull one person in there versus the other.
Yeah, I think that's right. And, each place is going to have its own, point of differentiation. We try to add, other elements beyond the simple transaction to keep people engaged in the platform. So I mentioned the blockchain market services infrastructure. So as we bring new tokens to market, the fact that we have a broad distribution network of 39 plus million verified users, they really love the fact that they can get access to new tokens, new rewards that come through our blockchain market services platform. And similarly, the tokens that are launching on our platform love the fact that we have that distribution capability. But we try to create like this flywheel ecosystem. And so you're not just singularly focused on one element of it, say the transaction of, a trade. There's more to it. There's more benefit to being involved, on the platform, whether you're a retail user, an institutional business, or high net worth family office, or a crypto, foundation.
It sounds like you're saying in addition to distribution and the long tail, right? Those are multiplayer tools. There are also single player tools to make you smarter and want to stay longer.
Yeah. And like you've probably heard, great businesses always think about the ability to cross sell and upsell. You can only really do that if you've got a great flywheel in infrastructure to be able to offer the products and services that really resonate with consumers. And this goes back to some of the data capabilities that we have and the ability to listen to and observe and understand, what our users really want and then bring that to market for them, I think helps create, better stickiness on the platform for us.
So how do you think about data as a moat, Mike? Because on one hand, blockchains, like by definition, they make everything radically transparent. But on the other hand, you're doing thousands of transactions or millions of transactions, as you mentioned, which that has to generate a lot of first-party data that you have.
Yes, some of the data on chain is certainly readily available. It's not super easy to actually process the sheer volume of data that's out there.
Oh, I've tried. I didn't know what I was getting into. I'm like, yeah, I can't make heads or tails of this.
Yeah, and in each market is very different. So having the capabilities to look at the data in aggregate, but then be able to look at local geographies and say, well, what is the use case in Nigeria, for example? And how do we use the data that we observe from the base set of users that we have there to go in with a local customized product of the crypto user base? We were able to do that last year in a really successful fashion, Nigeria being a use case for that. It's a market that has real world use case where, there's some challenges potentially with the banking system or the reliability of the currency. And so, our ability to listen and analyze data and explore what could be a great, unique offering that would really resonate with the user base there is just one example, a really successful example for us that we're hoping to replicate in other markets, with that local market playbook.
Mike, I want to talk about balance sheet and risk for a while. What's on a crypto brokerage's balance sheet that requires a sector-specific lens?
Yeah, so, we have a lot of assets and liabilities that are denominated in different currencies. Those could be different fiat currencies, but they could also be different tokens. There's some analogy to traditional finance companies that have assets and liabilities that could be denominated in dollars and euros or pounds or you name it. So, what you want to be able to do from a CFO lens is to be able to think about the matching of assets and liabilities and making sure you're purposeful in terms of are you tilting long, are you tilting short in any specific currency or any specific token, and what's the reason for doing so in terms of the overall potential volatility of the underlying asset or liability that we're talking about. From a regulatory standpoint, we have strict standards in terms of making sure that any customer liabilities that we have or deposits that are on the platform are perfectly matched, one for one. And so we have safeguards in place to make sure that we adhere to that. It's just an active part of the treasury function and one that we've invested in to make sure that we always have, sufficient liquidity. We think about duration matching, of assets and liabilities, with those underlying, tokens. But it's a complex matter, but one that we're, pretty well positioned to monitor and manage from a risk perspective.
As a CFO, can you just speak to duration matching? Because I find it so fascinating being in a market where it's always on, right? It's not like on the weekend. It's like, hey, not much is going to move in between now and Monday.
Yeah. So, for us, we always want to make sure that from a working capital perspective that we have really strong buffers to be able to manage the ebbs and flows of transactions that customers want to conduct on the platform. It's really just having a lot of oversight and deliberate focus on maintaining liquidity buffers at all times.
It's funny because no matter how complicated it gets, it really just is at the end of the day matching assets and liabilities, right?
Yeah, exactly. We've got a really strong treasury function and risk management function that has, great analytics, great dashboards to be able to monitor that in real time. And like I said, we always strive to maintain, exceptionally strong liquidity buffers to be able to respond to the market.
This question isn't necessarily about crypto. I mean, it can be, but for a brokerage, can you just make me smarter on what risks a brokerage takes on a single transaction? So we talked about the macro or the larger picture of the balance sheet, but if we zoom into one transaction, how does that work with the proposition of who owns what and the risk?
Yeah, I guess technically speaking, in a brokerage model, if you're transacting with our platform and you want to buy Bitcoin, for example, we might be holding that Bitcoin in inventory. And as we make those transactions, if we're sending you the Bitcoin, we then are taking that inventory, out of our system, moving it into your wallet. And so it creates an exposure for us, either long or short. And so what we have to do from a technology standpoint, we have really low latency ability to be able to hedge out any of the risk that comes from that. So the important part is, like, technically you're taking on risk as a principal in that transaction. And so I temporarily own the risk of processing that transaction with you, as opposed to matching the order with another user. We have really sophisticated technology that helps us hedge out that risk in real time. So at the end of the day, we've really mitigated that risk up front through the investment in technology.
If you look back 5 or 10 years ago, Mike, do you think it would have been much harder without this technology?
It's what's allowed us to scale and provide exceptional service to institutional players and retail users. And so they come to us for that low latency. It helps us, provide narrower spreads on transactions and better, price discovery for the user.
Everything moves so fast now. I'm thinking back to, I think it was in the early 80s, of how people were buying up the real estate next to the New York Stock Exchange because the coaxial cables gave you a signal that was just a little bit faster, so you could get an edge on any trade.
It's funny, leading up to this interview, I was just trying to think back through the history of how Tradfi markets were trying to do what crypto markets are doing, which is just speed up the flow of transactions and reduce transaction processing times. And I remember living through that. Financial services companies were locating as close as they could to the cables, they were going into the New York Stock Exchange, just so they could get just that micro edge in terms of execution speed and reduce latency.
But efficient market hypothesis, eventually that arbitrage always gets taken away.
Yeah. And then now you see this move to 24/7 markets to keep things liquid at all times. I think it's all kind of in the spirit of creating, access to capital and the ability to move capital in real time at the most efficient speed and cost possible. And cryptocurrency is helping enable that.
My on-ramp to crypto from at least an institutional or business perspective has been trying to get smarter on stablecoins. Do you have a lot of CFOs coming to you saying, hey, how could I possibly incorporate this into my business?
Yeah, it's a huge part of what we do. And, we are not like an issuer of stablecoins, but we facilitate a lot of transactions, and settlements in stablecoins. And we're actually one of the launch partners for one of the top 5 stablecoin issuers in the world, back to that blockchain market service platform that we offer. So, that's a bit of how we've participated in the ecosystem, and certainly I have a lot of engagement in terms of institutional players in that regard.
How do you map out the different risk vectors in your business?
If we start first in terms of accounting and infrastructure, what we've been really purposeful around is building proper, controls and risk matrices to make sure that we are capturing and aggregating all of the transactional activity that's happening in the business in real time, and embed the level of trust and control in the business that will stand up to SEC scrutiny and institutional scrutiny. And trust is something that we've really prided ourselves on as an institution. It's what's helped us scale to the size that we are, and having processed over $1 trillion in transaction volume on the platform. So we continue to invest in trust and infrastructure and controls and governance in a significant way. In terms of the operating within a crypto environment, it's obviously a very volatile business. So we work really hard in terms of developing, liquidity forecasting models, planning models, so that we can try to improve the level of forecasting and visibility into the business. One thing that we've really focused on strategically is building up our subscription and services components to our revenue, so that you add more fee-based elements and subscription-based components to the business that provide extended visibility, more predictability to the business. So I would say those are a couple of the elements of risk management that we think about in terms of making sure that the business has the proper controls and governance around it, but then also, as much as you can within crypto, building visibility and predictability to the business model.
Is there anything unique about your annual planning process?
I don't think that there's anything probably super unique to what we do. We try to gather our business leaders around the world multiple times a year, dive into the consumer insights, institutional insights, and make sure that we are focusing on the big priorities, the big things that our consumers want for us in terms of top line initiatives. And then we set priorities around that and really drive accountability, to deliver on those, growth initiatives. And I think that type of focus is what, again, going back to that all-weather business model, allows us to have initiatives in place that, regardless of what the environment is offering to us in terms of how robust or not business environment may be, we have levers to pull that allow us to outperform and drive growth.
We spoke to the CFO of Rocket Mortgage, and I asked him a similar question. I'm like, dude, how do you possibly do this when you don't know if the Fed's going to wake up tomorrow and change the rates on what mortgages are going to be? And he said something similar. It all comes back to serving the consumer. And if you break that down into, well, what's the 10-year vision of that? What's the medium-term vision? And what's the annual plan to execute on that? Like, the other stuff is kind of just noise in between.
Yeah, I always found like the best management teams, in my career looking outside in at companies, were those companies that tended not to blame or credit the market environment that they were operating in, but spoke to the various levers that they had to pull regardless of the environment to drive, growth and outperformance. And those are some of the disciplines that we're building here at blockchain.com and looking to leverage in continuing to drive, differentiation and outperformance in the years to come.
I'm going to take you into what we call our long ass lightning round. I ask every successful person that comes on the pod, what's an example of something you've screwed up on the job before? It could be here or a previous role.
Making a bad stock call. The best investment managers are right 55 to 60% of the time. So you have to deal with failure 40 to 45% of the time.
Is that really what the ratio is? You're one of the best if you can do 55%?
That's about right. So, you learn a lot about, maximizing winning bets and cutting off losing bets as fast as possible. And you try to bring that into the office of the CFO as well. You want to make sure you contain things, where you explore from an R&D perspective, things that you think are interesting. But if the thesis isn't playing out, you reallocate capital to the better projects.
Do you think you got more comfortable with the concept of sunk costs or the sunk cost fallacy by being involved with stocks for so long?
I think so. And maybe even growing up playing baseball as well, which is an even worse success rate, when you're trying to hit a round ball with a round bat and, the best are only successful at doing that 30% of the time.
Right. Ted Williams wasn't even 50%.
That's right.
More of a technical one for you. Can you walk me through your finance software stack? What tools does your team use to get the job done?
Yeah, so we use NetSuite as our ERP, Flowcast for a close process, and we use Workiva to help, take those trial balances and put them into, SEC ready financial statements and documentation.
Last one I got for you. If you could tell your younger self something knowing what you know today, what would you tell them?
To believe in yourself, have confidence, try new and hard things. It's the way to have a growth-oriented mindset, which I think is really critical for success. And combine that growth-oriented mindset with also having a owner's mindset in everything you do. Because I think if you can, behave and act like an owner, it really ingratiates you to founders, other management teams, and investors that this person's going to wake up every single day trying to drive value for the business.
I love that. Think like an owner. Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.